As the old saying goes, the beatings shall continue until morale improves. My name is Keith Richards. I am President and Chief Portfolio Manager of ValueTrend Wealth Management, and I'm a technical analyst. And today, we're going to take a look at the good, the bad, and the ugly of the stock market and where the next move might be. Let's get started. Okay, well, before we get right into the stock market charts, which you know I'm going to put up, I wanted to show you a couple of other charts that I think are significant for this discussion. And one is the European bond markets compared to the United States bond markets. And you could apply the same to Canada. So let's just take a look. And I want to show you some compelling evidence suggesting that European rates are suggesting that there's a positive economic outlook versus in the US and in Canada, the rates are showing there is a negative forward outlook. So let's take a look. As you can see here on the chart, we have several UK indices. I should say several UK bond markets. We have the UK, we have Italy, France, Germany. You guys might have heard the recent news that Germany had a fairly good recent quarter for their economic output. Now, US, which has been the leading market for more than a decade, is starting to feel some pain, and that is being reflected as the long bonds are declining in rate. Now, you guys might know that a few months ago, I was recommending that you take a look at the US long bond. And in fact, at ValueTrend, we bought the US long bond a couple of months ago, and we've made good profits on it so far. And it's been a non-correlated asset to the stock market, which makes it even better. In my opinion, the US long bond still has some legs left in it, and ValueTrend continues to buy it. But what I'm trying to show you here is that if we look at Italy and France and Germany and the UK, we'll see that rates are going up on the long bond. The long bond is a measurement of bondholder and bond investor confidence in the economy. And obviously, Europeans are more confident about their economies than we are here in North America. Okay, the next chart I want to show you is actually related to the bond market chart that we were just looking at. This is US bonds, high yield bonds only. So some people used to call them junk bonds. Really, they're just kind of high yield bonds. Bonds that are not investment grade. And what we're seeing here is a comparison between long bonds and short bonds. It's taking the short-term high-yield average rate of return on their bonds and compared to all other bonds, including right up to the 30-year bonds that some of these corporate lower-grade companies are issuing. And what we've seen is when there's a lot of confidence on risk. So in other words, a high risk appetite by investors, investors will not command too much of a premium on the 30-year bonds versus the short-term bonds. This is a sign of what we call risk appetite, and that's what we're seeing right now. So let's take a look. So let's go right back to 2005, and you'll see that whenever the spread between short bonds, short junk bonds, and long bonds is very low. In fact, if we zoom in here, I just want to show you, I've drawn a line at around 3%, and I've drawn a line around 7.5%. What I have found is when the spread differential between the rates on shorter term versus long term, in other words, the premium you get to get a long-term bond, a long-term junk bond, versus a shorter term bond is only around 3% or less. That means that investors have a very high risk appetite. And that's actually not a great thing if it lasts too long. And the history proves that. So let's take a look. If we go back to 2007, do you remember what happened in 2008, the year after that? The market crashed. Well, 2007, we saw long bonds paying only about 3% or even less over their short-term counterparts. Same thing in 2014, which led into a correction in 2015, you can see here. And same thing in 2018-19, which led into the COVID correction. You can see that rates were very close to that 3% spread between long and short bonds. And here we go again, 2022, you guys know coming into 22, so 21, and if I zoom in, you can see 21 leading into 22, rates were down around that 3% differential between short and long bonds. These are not actual rates. These are the differences. In other words, the premium you would get to buy, say, a 20 or 30-year bond in the same company versus a shorter term bond. So what you're seeing here is, here we go again, I guess we could call it. We are seeing around a 3% or less spread, and we are near a top on the market. So this is what should concern you and I. It can be an indicator that tells us that bad news is to come. So we've looked at a couple of things. We're seeing that the American economy is, as the Canadian economy, doing worse than it was over the past couple of years. And we're also seeing that risk appetite's been too high. So that's a concern. Let's get on to our next thing. I want to now look at the S&P 500's chart. And this is really the nuts and bolts of it. So even if you kind of glaze over of the charts I just showed you, pay attention right now. Okay. So pay attention, class. So what I have been talking about in my online technical analysis basics videos that hopefully many of you have watched, I talk about trends and how you identify trends, and that is higher highs, higher lows. You can see we've been getting that on the S&P. There's a peak, there's a trough, there's a peak, there's a trough, constantly getting higher. But what's happened recently is the last significant trough was around 5,800. That was taken out. You can see that if we zoom in, over the past couple of weeks, the S&P 500 broke that 5,800 prior low. So we have a lower low, and that's a bad thing. Okay, now we're also seeing that this red line, which is the 200-day moving average, also known as the 40-week, this is a daily chart, so this is the actual 200-day moving average, was tested. Now, interesting, again, we should zoom in here. You can see it was tested, but it didn't fail. It intraday failed, and we'll talk about this candle in a minute, but it managed to hold the 200-day moving average. At the same time, we are getting signals on very fast-moving momentum indicators, and I recommend you see my momentum video to understand how these work, but stochastics and RSI and this Bollinger Band here, which is a volatility band, all three of these indicators are showing us that the market's a bit oversold. Again, see my momentum video, link below. Now let's look at the TSX. Well, interestingly enough, you guys know, if you follow my videos regularly, that since January, I have been saying that the TSX would likely outperform the S&P 500. I presented my evidence back then, and I've been right. You can check. I always tell you that, the good thing about these videos is, they're there for you to see, and you can find out if I was right or not. Well, I got a lot of flack on that. People going, oh no, the US market's the only place to be back in January. Well, guess what? Here's what happened. The TSX made a low at around 24,400. It recently tested, but did not break that low. Now remember, going back to the S&P chart we just looked at, the last low at 5,800 was broken. So the TSX has outperformed the S&P 500. Another thing that you should pay attention to is, remember how the S&P 500 was riding along the 200-day moving average. It had not broken the moving average, but it was riding right there. It was like precariously sitting at the 200-day. Well, guess what? There's the 200-day for the S&P TSX 300, and you see there's a big gap. There's lots and lots of room before the TSX even gets to the 200-day moving average. That's good news. Also, we can see, though, like the S&P 500, both of these indicators, stochastics and RSI, are a bit oversold on the daily chart. So what we are seeing here is that TSX is holding support. S&P has broken support. Both of them are above their 200-day moving average. Both of them have oversold signals from momentum indicators. So what I might anticipate is the probability of some type of short-term move to the upside on both of the North American indices that we were just talking about. From there, though, what's important to find out is, will that hold? Because if it doesn't hold, then the market will turn back down again. And if it breaks that 200-day moving average, that's when we move into a genuine bear market. Now, I don't predict, I only prepare. Right now, officially, even with the S&P taking out the 5,800 last lower low, it has not cracked the 200-day moving average. Therefore, we are still in an uptrend. At this point, we are consolidating, but that could change. I do expect a short blip to the upside. If that continues and carries on, that's good news. The market may have absorbed the bad news of the tariffs and all that sort of stuff and move on to higher highs. But if it does not, then I would anticipate that if the 200-day moving averages on both of these indices are broken, the market is going to be entering into a bear market. No predictions. I did not say it is moving into a bear market. I said those are the conditions. If we see those conditions, then we could move into a bear market. So let's get down to some encouraging evidence to suggest that maybe that won't happen. So this is, on the bright side, an indicator that looks at the American Association of Individual Investors, and it looks at how many people that follow that institution are bearish. So it's got many thousands of investors, and they answer this survey and they tell you if they're bullish or bearish. Well, generally, if there's too many bulls, that's a bad thing. And if there's too many bears, that's a good thing. It's a contrarian investment indicator. So we're only tracking the bears, and I want you to look at this chart right now. And what you can see is this is going back to about 15, and you can go back as far as you want. You will find this pattern repeats. So if we look at before 2020, we had a clusters of too few bears. Then, of course, when the market fell in 2020, there were lots of bears. So we had too many bears. And I draw horizontal lines as to where I think those levels indicate too few or too many bears. So here we go again. In 2021, through much of the year, we had too few bears. Everybody was bullish. Well, that led into this, okay? Just like 2020 had too few bears, and 2018 had too few bears, which did lead into a little correction there. So on and on, you will find that the bigger the cluster, which includes clusters when there's too many bears, like up here, then as the 2022 market fell, that can lead into a market bottom. So recently, through most of 2024, we saw way too few bears. Everybody was bullish. And, you know, that often happens as the market continues going up and up. But at some point, you've been riding that bull market for too long and everybody's bullish. And that's where we were. And so what, of course, has happened is the market's been falling just recently. And you see that the bears have suddenly come out of the woods. So people have gone from being bullish to bearish, and we're suddenly seeing this fairly large spike on the AAII survey of who's bearish. So this is bears only. Now, if you look at past instances, you can see, like in 2020 and other periods like that, that you need a period of time, just like you need a period of time where there's too few bears to indicate that the market's topping. You also need a period of time where there's too many bears to indicate that this is the end of the sell-off. But it is encouraging that we've gotten this spike. Will it last? I don't know. It's very early. Like I said, I like to see a cluster like up here. We've not got a cluster. We've got one move, okay, above that too few bears line. But keep that in mind, because that could be evidence that this market will, in fact, find a bottom. Too early to tell yet. Okay, the final chart I want to look at is a real close look at the market. It's really over the past 2 or 3 weeks. It's going from February the 7th, as you can see here, and I'm recording this on the weekend after March 7th. So what you can see is we had a whole bunch of black candles, and that means that the market was going down. When the market closes lower than it opened, you get a solid candle. Interesting, if you followed my video on candlesticks, and again, I'll make sure there's a link down here. Click on that link because you really do want to understand how candlestick formations work. Well, we got what's called a hammer here, and hammers are reversals. So we got a hammer, and then the market, sure enough, did reverse, and we had a whole bunch of mostly down days, and that's indicated by these dark candles. Well, what's interesting is that on Friday the 7th, and I'm recording this on the 9th, I believe, the Sunday, well, you can see that we had what's called another hammer type candle. That is that where the market was open and close was near the top of its range, but it did have an intraday low. And that means that there was some sort of a reversal that day, and typically means some sort of a turnaround. This was a dark candle where it closed lower. This is a white candle. So if I reverse that so you can see that a little bit better, this is a white candle, meaning it closed higher on the Friday, even though on this day we had a much lower low. In fact, it broke the 200-day for a few hours that day before it turned around. So these are often turnaround signals, and that means that the market could in fact move up, and that's what those momentum indicators we were just looking at, like stochastics and the Bollinger Band and MACD and stuff, they were all telling us that the market may have some upside to come in the next few days to maybe a couple of weeks. After that, we have to see if it will hold, and nobody knows the answer to that. So my answer right now is very, very likely chance for some sort of a rally on the markets. And then from there, we'll have to see what happens. But at least it gives you some insight as to where we are on the markets. I call it an inflection point. The market's at an inflection point. Final thing to talk about. I'm on BNN this Wednesday, March 12th at 12 noon. Now, sometimes viewers of these videos will, in the comment section, ask me a question. What do you think of this? What do you think of that? I can't answer those type of questions. I cannot give stock advice or directions on YouTube, not individual stock advice. I can comment on sectors like I do, but I can't give individual advice to an individual. That's just part of the compliance rules in my industry. However, on the BNN show, you can phone in and I will answer your questions on individual stocks and sectors and that kind of thing. So please be sure to watch the show on Wednesday and phone in if you have a question on a stock, and I can answer it on that show because there's all kinds of disclaimers on the show, so I'm allowed to do that. So hope to see you then, although I won't see you because I'm on the other side of the camera, but be sure to watch the show and we'll catch you next time. Hey, thanks for watching. I hope you got value out of this episode. Please like and subscribe below. We're trying to grow the channel and it would really be doing us a big favor. I'm presenting ideas every week on trades that we're actually looking at ValueTrend. And by the way, I don't just talk the talk, I walk the walk. I have been a portfolio manager for 35 years. And in fact, I was one of the very early pioneers in technical analysis here in Canada. On my website, valuetrend.ca, you will see a link for our online trading course. And this course is a complete money management system. I do encourage you to take a good look at that and consider taking it. I priced it extremely low because I want retail investors, that's you, to take the course and get value out of it. It's literally my 30 plus years of experience put into one complete step-by-step course. And honestly, I wish that I had had something like this when I was an early investor. It really will stop you from making so many mistakes. I also suggest you subscribe to our Never Miss an Opportunity program, which is our blog and our newsletter. There, you're going to get ongoing ideas, tons of charts, lots of trading ideas. And by the way, we never, ever solicit. We don't send you junk, spam, and stuff like that to try to get your business. It's for information because part of my passion is to teach retail investors how to invest properly. I've been doing this, as I said, for 35 years, and I hope that I'm able to pass on some of the things that I've learned through this career as both a pioneer in technical analysis in Canada and a longtime portfolio manager. Thanks for watching. Don't forget, push like, push subscribe. See you next time.